Hello everyone. Have you noticed how employment and investment prospects seem increasingly uncertain lately? Behind the global economic turmoil lies a major restructuring set to shape the next decade. With America's harvesting tactics losing traction, capital is flooding into China. But what's really driving this shift? Today we'll dissect it entirely with real data, revealing the economic truth. Many of you may sense that recent years, whether in local job markets, investment opportunities, or global news, have carried an air of economic volatility and uncertainty. Yet few can articulate the core logic driving these shifts. Today, I'll unravel this global economic chessboard using only verifiable data and established facts. We won't speculate or spin narratives, just tangible trends and their foundational principles. By the end, you'll gain clearer insight into the economy's trajectory. First, let us pinpoint the most pivotal trend: the efficacy of America's bloodsucking tactics. Raising interest rates and shrinking its balance sheet to harvest global resources is steadily diminishing. Why? Because the economies once treated as its cash machines are now actively resisting, with Europe being the most prominent example. Since 2022, the US has aggressively raised interest rates with a singular objective: to siphon global capital back to its shores, shoring up domestic economic weaknesses and perpetuating its hegemonic model of reaping others' gains while reviving itself. This time, however, Europe has not passively absorbed the blows but has deployed tangible countermeasures. Most notably, Europe's core economies, particularly Germany, have proactively strengthened industrial cooperation with China to hedge against dependence on the United States. Data confirms that German investment in China reached €5.7 billion in 2024, a 25% surge from 2023. In the first half of 2025, Sino-German trade volume reached $101.07 billion, marking a 3% year-on-year increase. At this trajectory, China is likely to reclaim its position as Germany's largest trading partner by 2025. Consider the actions of German corporations. Volkswagen's R&D center in Hefei, with a total investment nearing €1 billion, accelerated development speed by 30% and reduced costs by 40% upon its 2024 commissioning. Bosch Group has been intensifying its investment in autonomous driving R&D in China. BASF has also injected an additional €50 million into its Shanghai Pudong plant, dedicated to producing components for new energy vehicles, with production capacity expected to increase by 70% upon commencement in 2027. These German enterprises are not foolish. They are well aware that China possesses a complete industrial chain and a vast market. By allocating capital and production capacity to China, they can both stabilize production and hedge against the risk of capital outflows triggered by US interest rate hikes. This represents a silent resistance to America's bloodsucking strategy. Turning to energy, while the EU now imports significantly more LNG from the US than before by Q2 2025, American LNG accounted for 27% of the EU's total gas imports, a multiple increase from 4% in 2019, and 58% of its LNG imports. From January to April 2025, 67% of US LNG exports were destined for the EU and UK, significantly higher than the 37% recorded in early 2019. Previously, the US and EU agreed that the EU would purchase $150 billion worth of energy products annually from the US over the next 3 years. However, actual implementation has fallen far short of this target. In the first half of 2025, the EU spent approximately €22 billion on US LNG and €45 billion on crude oil and refined petroleum products, remaining considerably distant from the annual goal. Consequently, the EU is quietly making strategic moves. On one hand, vigorously developing renewable energy. On the other, seeking alternative supply channels. The underlying aim is to avoid being held hostage by the US in energy matters. After all, complete energy dependence on the US would equate to surrendering economic sovereignty, potentially leaving the EU vulnerable to arbitrary exploitation. Moreover, US tariff policies are compelling Europe to unite. Eurostat data from July 2025 revealed that, impacted by US tariffs, The Eurozone's second quarter GDP grew by a mere 0.1%, the lowest recent figure, with major economies like Germany and Italy experiencing minor fluctuations, while Ireland's economy even contracted by 1%. Confronted with this situation, the European Central Bank is adjusting its policies. While the EU and its member states are increasing defense and infrastructure investments, aiming to stimulate the economy through domestic demand, countries such as France and Spain, relying on domestic consumption and investment, have maintained relatively stable economic growth rates. This demonstrates that the European economy is not merely passive to US influence. It possesses its own resilience for recovery. Having discussed Europe, we now turn to Japan. Many perceive Japan as having adopted a passive stance amid global economic turbulence, yet this is not the case. Japan's lying flat strategy represents a meticulously calculated defensive approach, centered on retaining industrial capital domestically while leveraging external markets for breakthroughs, thereby avoiding becoming America's sacrificial pawn. Regarding monetary policy, Japan implemented negative interest rates from 2016, later complemented by yield curve control to maintain a low interest rate environment. It wasn't until March 2024 that rate hikes commenced, initiating monetary policy normalization. By December 2025, four cumulative rate increases had pushed the policy rate from 0% to 0.1% to 0.75%, the highest level in 3 decades. This pace is clear-cut. It avoids the financial risks of prolonged low rates, retains domestic capital at critical junctures, and aligns with the reality of rising domestic inflation. Regarding capital controls, Japan avoids explicit restrictions, opting instead for indirect guidance. For instance, it channels capital towards key domestic industries through industrial support and tax incentives. Simultaneously, it strengthens overseas investment reviews, encouraging firms to retain core technologies and production capacity domestically, outsourcing only non-core operations. This approach avoids accusations of capital controls from the international community while stabilizing the domestic industrial ecosystem and safeguarding competitiveness. The most telling manifestation of this strategy lies in the actions of Japanese automakers. In the critical arena of new energy vehicles, giants like Toyota, Honda, and Nissan are intensifying their investments in China rather than following the US lead in relocating production capacity. Toyota signed a strategic cooperation agreement with the Shanghai municipal government in 2025 to establish a new energy vehicle plant in Shanghai dedicated to localized production and R&D. Honda is accelerating the construction of electric vehicle production bases in Wuhan and Guangzhou. Nissan has even announced an investment of 200 billion yuan, approximately 10 billion yuan, over the next 2 years to comprehensively expand its presence in China's new energy market, alongside launching 8 new energy vehicle models. Next, let us focus on China's countermeasures. The three-pronged approach proposed by China: preventing capital outflows, revitalizing existing real estate stock through state reserves, and creating incremental growth through nationwide water circulation projects, is not merely theoretical on paper. It has been implemented nationwide and has yielded tangible results. These measures are interlinked, simultaneously safeguarding the bottom line, activating existing assets, and cultivating new growth drivers, with each step underpinned by solid evidence. First, capital outflow prevention. Since 2018, China has prioritized this issue by strengthening foreign exchange controls and regulating cross-border capital flows, effectively sealing major capital flight channels. As global economic conditions grew increasingly complex, China further intensified monitoring and regulation of capital movements, particularly implementing numerous financial sector measures to prevent large-scale outflows of personnel, capital, and assets. In practical terms, while global capital was drawn towards U.S. interest rate hikes, China avoided the chaotic capital flight seen in Latin American nations. Domestic capital remained stable, and the country even attracted substantial high-quality foreign investment. From January to November 2025, 61,207 new foreign-invested enterprises were established nationwide, representing a 16.9% year-on-year increase. Countries such as Switzerland, the United Arab Emirates, and the United Kingdom all recorded significant growth in actual investment into China. This influx of foreign capital provides robust financial underpinning for China's economic development. Turning to the National Reserve housing policy, its core objective is to revitalize existing assets rather than merely propping up property prices. Pilot schemes in Shandong and Jiangsu have demonstrated highly visible results. Qingdao, Shandong incorporated several financially distressed yet prime seaside developments into the National Reserve housing system, converting them into public rental housing and talent apartments. On one hand, this resolved housing issues for thousands of new urban residents and young people, alleviating social pressures. On the other, as populations moved in, previously quiet commercial streets nearby became bustling, with supermarkets, restaurants, and educational institutions establishing themselves. This created a virtuous cycle where housing drives consumption, instantly revitalizing the regional economy. Suzhou in Jiangsu province adopted an even more forward-thinking approach, converting high-vacancy office buildings into incubators for science and technology innovation enterprises, thereby aligning existing assets with industrial upgrading. By November 2025, Suzhou boasted 24 provincial benchmark incubators, accounting for nearly one-third of the province's total. These incubators span emerging sectors such as artificial intelligence, green technology, and embodied robotics. For instance, the Suzhou University Tiangong AI Incubator has nurtured 120 enterprises, including 17 high-tech firms and 3 listed companies. Among the 67 enterprises at the Qingyuan CTech Green Technology Incubator, 64% are technology-based SMEs and 31% are high-tech enterprises. To bolster these incubators, Suzhou introduced specialized policies, providing construction and performance subsidies to provincial level and above science and technology incubators. Between 2022 and 2024, cumulative subsidies exceeded 80 million yuan. Concurrently, tax incentives were implemented, with incubators collectively enjoying 23.5376 million yuan in tax exemptions during 2024. This model of repurposing existing real estate as innovation platforms not only revitalizes dormant capital, but also injects fresh momentum into industrial upgrading. Finally, the National Water Cycle Project represents China's new engine for economic development. Unlike previous infrastructure investments focused on railways, roads, and public facilities, this super project targets ecological conservation and rural revitalization, encompassing wastewater treatment, water conservancy upgrades, and multiple other domains. The project's greatest benefit lies in generating substantial, stable, localized employment opportunities, enabling migrant workers to find jobs close to home. Take the ecological restoration and water circulation project in Hanan's Yellow River Basin as an example. It has not only resolved irrigation shortages and unregulated sewage discharge in riverside farmlands but also spawned entirely new industrial chains. Local steel enterprises have pivoted to producing corrosion-resistant, high-strength specialized water conservancy pipes. Building material firms have developed eco-friendly cement, and internet companies have created smart water conservancy monitoring systems, integrating sensors and big data technology into river monitoring. In terms of employment, a water conservancy construction site in Minquan County, Hanan, has absorbed over 200 returning migrant workers, with average monthly incomes exceeding 6,000 yuan per person. These earnings flow directly into local consumption markets, purchasing rice, flour, cooking oil, household appliances, and children's tuition fees, thereby invigorating county-level economies from the grassroots level. Concurrently, this project has absorbed surplus steel and cement capacity from the property sector, achieving beneficial industrial complementarity and providing sustainable momentum for economic growth. Having examined national responses, we now turn to a pivotal trend: the historic shift in global capital flows. Capital inherently seeks profit, gravitating towards stability and growth potential. While overall global foreign direct investment (FDI) is declining, China stands as an exception. particularly in manufacturing and high-tech sectors where its FDI attraction remains remarkably robust. UNCTAD reports indicate that global FDI has declined for several consecutive years. However, data from China's Ministry of Commerce reveals that from January to November 2025, the nation's actual utilization of foreign capital reached RMB 693.18 billion. Within this, manufacturing attracted RMB 171.72 billion, while high-tech industries drew RMB 221.26 billion. Notably, the e-commerce services sector, medical instruments and equipment manufacturing, and aerospace equipment manufacturing saw actual FDI utilization surge by 127%, 46.5%, and 41.9% respectively, demonstrating their compelling appeal. In contrast, some developed economies are experiencing a slowdown in FDI growth. Data indicates that in 2024, European foreign direct investment fell to a 9-year low, with project numbers decreasing by 5% and job creation declining by 16%. U.S. investment in Europe also reached its lowest level in nearly a decade, accounting for only 18% of total foreign investment projects in Europe, a significant drop from 24% in 2015. In the first half of 2025, German exports to the United States declined by 3.9% year-on-year. Commerzbank forecasts this contraction could widen to 22–25% over the next 2 years. This indicates Europe's diminishing appeal to global capital. Multinational corporations' actions speak volumes. Tesla's Shanghai Gigafactory has become a pivotal global production and export hub for the company. Its stable output capacity and efficient supply chain have prompted continuous investment expansion. BASF has not only established an integrated production base in Zhangjiang but also expanded its investment in Shanghai's Pudong area, focusing on new energy vehicle components. Automakers such as Volkswagen and BMW are also intensifying their investments in China's new energy sector. These corporate choices speak more persuasively than any analytical report. China has transformed from a former capital outflow destination into a global safe haven for capital and a source of growth for the world economy. Why has this shift occurred? The core reason lies in the enhanced competitiveness of the Chinese market. China possesses a comprehensive industrial ecosystem, covering the entire value chain from R&D and production to sales. Enterprises here enjoy high production efficiency and rapid iteration cycles. The vast domestic market provides stable demand, mitigating risks from external market volatility. Moreover, China's business environment continues to improve, with sustained increases in investment in scientific and technological innovation. In sectors such as new energy, intelligent equipment, and high-end chemicals, China has developed unique advantages, becoming an indispensable hub in the global industrial chain. Turning to the United States, its strategy of interest rate hikes and balance sheet reduction has now reached a critical impasse. Whether it continues raising rates or halts the process, both paths carry unmanageable risks. This predicament stems from inherent policy contradictions compounded by external constraints arising from shifting global economic dynamics, manifesting as mounting debt pressures, economic damage to allies, and the growing prominence of domestic capital sunk costs. Consider the consequences of persisting with rate hikes. In the short term, higher rates may indeed attract some capital repatriation. Yet, sustained tightening would heighten the risk of economic collapse among allies, ultimately backfiring on the United States itself. Should the U.S. maintain elevated interest rates, European economies would face further strain, leading to a significant contraction in import demand. As Europe constitutes a vital export market for the U.S., a European recession would inevitably trigger a decline in American exports, thereby undermining its own economic growth. Simultaneously, persistent rate hikes would intensify global trade frictions, fragmenting global supply chains and further disrupting domestic industrial order in the United States. Now consider the risks of halting rate hikes. Should rates be abruptly cut, short-term capital previously flowing into the United States would likely flee en masse in search of higher returns, exacerbating domestic capital stagnation and potentially triggering fresh financial turbulence. Recall that from July 2022 to August 2024, The U.S. 10-year and 2-year Treasury yields remained inverted for an extended period. On the 3rd of July 2023, the inversion reached 108 basis points, a direct reflection of market concerns over the U.S. economic outlook. Debt pressures are even more pronounced. In the first quarter of 2025, the U.S. federal government's liabilities reached $31.77 trillion, with government sector leverage at 117.4%. During the first half of fiscal year 2025, the budget deficit hit $1.3 trillion, the second highest on record. In 2024, U.S. government interest payments reached $1.068 trillion. The interest cost on newly issued Treasury bonds in 2025 is 20% higher than at the start of the year, intensifying repayment pressures. Halting rate hikes or even cutting rates would lead to domestic capital shortages, contracting corporate investment, and further exacerbating downward economic pressures. The Federal Reserve's policy adjustments thus appear caught between a rock and a hard place. In December 2024, Fed officials hinted at two potential rate cuts in 2025, an expectation more conservative than investors anticipated. By the end of 2025, the Fed had cumulatively reduced rates by 175 basis points, bringing the federal funds rate to the 3.50% to 3.75% range. However, this incremental easing fails to address core issues. Inflation remains above the 2% target, while the labor market shows cooling signs. The prolonged government shutdown has disrupted economic data collection and publication, introducing further policy uncertainty. Investment institutions forecast that the Fed may continue cutting rates to 3.0% to 3.5% in 2026. Yet with increased debt issuance, long-term yields are likely to remain elevated. The 10-year Treasury yield is unlikely to fall below 3.75% and may even rebound to 4.5%. More critically, the United States credit rating continues to deteriorate. In May 2025, Moody's downgraded the country's sovereign credit rating to AA1, with all three major rating agencies having withdrawn the AAA rating. This directly triggered the 30-year Treasury yield to breach 5%. While the US dollar index plummeted from 109 to 98, resulting in a triple whammy of falling stocks, bonds, and currency. Against the backdrop of accelerating global de-dollarisation, the US dollar's share of global foreign exchange reserves fell to 58% in 2024, hitting a 25-year low. In the first half of 2025, foreign holdings of US Treasuries declined by 3% year-on-year, signaling a persistent weakening of America's ability to shift its debt burden. Domestically, the issue of capital stagnation has become increasingly pronounced. Vast amounts of capital have exited the real economy, transforming into cash reserves. This has dampened corporate investment appetite and placed pressure on the job market, creating a vicious cycle of rating downgrades, rising interest rates, widening deficits that has plunged the U.S. economy into deeper difficulties. Finally, let us discuss the de-dollarization process being advanced by the BRICS nations, led by China. This development is not a fortuitous choice but an inevitable outcome stemming from the recognized dangers of dollar hegemony and the global trend towards multipolar economic systems, manifesting through increased local currency settlements, diversified trade partnerships, and autonomous financial frameworks. This shift is reshaping the global economic order and profoundly affecting our daily lives. Regarding local currency settlements, BRICS nations have made significant strides, steadily eroding the dollar's dominance in international trade. Data indicates that the proportion of local currency settlements within BRICS nations surged from 18% in 2020 to 45% by 2025, directly undermining the foundations of US dollar supremacy. The new development bank NDB has further announced that 30% of its loans will now be issued in member states' local currencies, expanding the scope of local currency usage in financial domains. Cooperation between China and Pakistan serves as a representative example. Within the frameworks of the Belt and Road Initiative and the China-Pakistan Economic Corridor, bilateral economic and trade relations have grown increasingly close. The promotion of local currency settlements has reduced trade costs and exchange rate risks for both parties. Progress in local currency settlements for China-Russia trade has been even more rapid, rising from under 30% in 2022 to 95% in 2024, with the US dollar share falling to less than 5%. India is actively pursuing the dollarization, using renminbi to pay for some oil imports from Russia and experimenting with rupee purchases of crude from the UAE. Already, 44% of its crude imports bypass the US dollar system. ASEAN is accelerating its pace, launching a regional trade settlement currency initiative in 2025. The US dollar share in cross-border payments across Southeast Asia has fallen from 78% in 2015 to 52% today. In ASEAN-China trade, renminbi usage has risen to 38%, with cross-border settlements exceeding 60 trillion yuan, demonstrating increasing acceptance of the renminbi in Asian regional trade. Even Saudi Arabia has begun pricing oil exports in renminbi, with 15% of its oil exports to China now bypassing the dollar, further eroding the US currency's monopoly in international oil trade. These developments demonstrate that de-dollarization has become a shared objective among most emerging market economies. Globally, with the US dollar-dominated international settlement system gradually being dismantled, BRICS nations' advancement of de-dollarization fundamentally aims to escape the fate of being exploited by US dollar hegemony. For years, the United States has leveraged the US dollar's status as the global reserve currency to shift its own economic crises onto other nations. Through interest rate hikes, balance sheet reduction, and currency manipulation, emerging market economies have repeatedly suffered severe capital outflows and economic downturns during such crises. Thus, the BRICS nations' drive for de-dollarization seeks to establish a fairer, more stable international economic order. This would realign trade settlements and financial cooperation with the needs of the real economy, rather than serving America's hegemonic ambitions. Some may feel these are matters of national significance, bearing little relation to their personal lives. Yet this is not the case. This reshaping of the global landscape is intrinsically linked to each of our employment prospects, investment opportunities, and consumption patterns. Regarding employment, deepening trade cooperation among BRICS nations will steadily increase job opportunities within relevant industries. For instance, collaboration between China and Brazil in energy and infrastructure sectors has generated substantial local employment. Similarly, expanded partnerships will foster new positions within domestic supply chains. Regarding investment, the promotion of local currency settlements reduces exchange rate risks, diversifying investment channels for both businesses and individuals. The appeal of assets in emerging market economies is rising, broadening investment options beyond traditional domains. In terms of consumption, reduced trade costs will bring more affordable, high-quality goods to global markets. We can purchase cheaper imported products, while citizens of other nations gain access to China's premium goods, enhancing the overall consumer experience. Concurrently, de-dollarization is driving the diversification and restructuring of global industrial chains. Enterprises will no longer be overly reliant on single markets or monetary systems, significantly enhancing the stability and security of supply chains. This will foster greater stability in employment and income, alleviating concerns that policy shifts in any single nation could disrupt livelihoods. To summarize, the current global economic landscape is undergoing a restructuring of order triggered by a financial gambit initiated by the United States. America's blood-seeking strategy is failing, leaving it in a dilemma. China, through its combination of preventing capital outflows, revitalizing existing capital, and creating incremental growth, has stabilized its own development and attracted global capital, while the de-dollarization advanced by BRICS nations is reshaping the global economic order. Lu Qiuan anticipates that 2023 to 2033 will constitute China's new golden decade. The core of this prediction is not sustained high-speed economic growth, but rather China's transformation from a rule follower to a rule setter within this reshaping landscape. The financial warfare initiated by the US, intended to consolidate hegemony, has unexpectedly accelerated China's internal reforms. cleared bottlenecks in industrial upgrading, and united more partners. Naturally, the path ahead will not be without challenges. Lingering pandemic effects, geopolitical tensions, and technological rivalries may introduce variables. Crucially, however, China has established its own cadence, no longer dictated by America's financial cycles. We possess a vast domestic market as a buffer, a comprehensive industrial ecosystem as ballast.